Peter Eliades with you. This is Stock Market Cycle's YouTube update for, well, very late at night. Pacific time zone, 11 o'clock, 11 p.m. is when I'm beginning this recording on Wednesday, May 31st, the last day of May. We have not done a YouTube update for probably around 6 weeks now. The last update we did was, I'll show you the date right here, right in here, April 13th or 14th, okay? And we were very bearish then because of the VIX index. We'll show you that a little bit later. What I want to start out with now is an interesting trade recommendation that we made. It's not only interesting, it's very, very, very rare. We've been doing YouTube updates, probably for at least 3 or 4 years, maybe longer. And we've been doing paid subscriber updates for almost the same amount of time, for at least 3 years, on basically a daily basis, each market day, with very few exceptions, okay? And over that time, I have never made a specific recommendation. There are many reasons for that. A lot of them relate to regulatory authorities and getting very strict when you start making recommendations. I want to avoid that hassle. But second of all, I want to concentrate on the analysis and not worry about stops and where you should enter and what you should do, okay? But there are several reasons for not ever giving recommendations. But we reached a point a few days ago on our weekend update last weekend, and I said, okay, the reason I'm giving this trade is there is very, very little risk, okay? I like trades like that, and the potential is great, was great at the time. So how did I determine the recommendation of the trade? On the weekend update, and here's the weekend right here. This is the 26th. Let me show you up and down on this. So the upper chart is the S&P futures, daytime only. The lower chart is the S&P cash. This was the day, actually the day after this was Friday. We didn't do our update till a day or two later, Saturday, Sunday. But was before this day, okay? And what we said was short the S&P, daytime trading, which would mean not until Tuesday. This is Friday right here. This is Tuesday. And let me tell you why I said that. There's an old pattern recognition. It goes way, way back, decades, that has worked quite well between the futures and the cash. See this high that was made February 2nd, okay? The high on the S&P, 41.95.44. We'll go to the futures in a moment, but right now I want to concentrate on the S&P. So that high of 41.95.44 was penetrated or was exceeded beginning on May 18th. In fact, it came very close to right here, 41.86.92. But it was definitely exceeded here. This blue line is an exact horizontal line at 41.95.44. This exact high on February 2nd. So it got exceeded here on May 18th, 42.02.20. May 18th, May 19th, and May 22nd all exceeded the February 2nd high. Then we had a little pullback, and we came back again on Friday of last week to exceed that high again. So there were 2 times when this high on February 2nd was exceeded. Now look at the futures. Here's the high on February 2nd, 4243.25. Let me do this so we can see above and below. Look below. This is where the cash exceeded the February 2nd high. Now look at the chart above. Did that go above the blue line? No. When that happens, that's usually a good sign for shorting. In this case, shorting because there's a divergence between cash and the futures in terms of making new highs. You do the same thing with new lows too in terms of pattern recognition. So right here, the cash made a new high, futures did not. They came down and look what happened again. The cash made two more, the bottom chart, two more moves above the February 2nd high. The futures could not do it. Now on this day on the futures, the high was 42.38.50. If you look at Globex overnight trading on both Sunday night and Monday night, guess where the S&P futures went? 42, 43, 25. This exact high on February 2nd. But the most important thing was, even overnight, this high was not exceeded. So it made this trade recommendation so easy. You short the S&P on the opening here, daytime trading hours, on May 30th, okay? Here's Friday the 26th. Remember, there's a Monday holiday, so there's no trading on the 29th, daytime trading hours. Here's the 30th. Here's where the open was. What I did was I took a half-hour chart of the S&P futures and looked at the average price for the opening half hour, and that was our shorting price. So our recommendation is officially short the S&P at 4230.75. But we'll see how it works out. It may not work out. We may be stopped out. The stop again, 42, 43.50, just above this February 2nd high in the futures. See where it says high there? 42, 43.25. We've got to stop at 42, 43.50. I won't say no risk, but very, very little risk in terms of a short position. The potential rewards, not even going to go into that now. But I wanted to show this to you, you YouTube viewers, because a lot of times you folks also complain that, hey, you never give us any trades, okay? There are reasons for that. But this time, very, very low risk. So far, a virtually perfect trade, but I'm not getting cocky about it. We'll watch it from day to day. Okay, let's get on to the market. Okay, above the VIX index, these are daily readings. Below, S&P 500, daily closes. Now, when I did my research initially towards the end of 22, coming into 23, the level that I used was arbitrary. I started out with saying, let's take a look at things when the VIX gets under 20 in a bear market, okay? And so that happened. Here's the 20 reading right here. You can follow this across. You can see that there are some areas here and here where that occurred. And my general rule was, in a bear market, when the VIX index gets below 20, again, it was an arbitrary level at the time, you draw in a tops line, descending tops line, after that level is hit, and a move above the tops line is a sell signal. Well, there have been a group of sell signals, okay? We had one right here towards the very beginning. This is the all-time high in the S&P. So you got a sell signal right here. When you get below that 20 level, actually this is below the 18 level now, you draw in a downtrend line and get a sell signal right about here. I'm not going to go through all of them for you now. What I'm going to say is that I finally settled arbitrarily again to use a level of 18.0 on the VIX index. Anytime there's a reading of 18.0 or lower on the VIX index, we draw a downtrend line, and when you break the downtrend line on the VIX to the upside, that's a sell signal, okay? And we've got several of them. We got them going back. I mean, each time we got one, though, there's a tendency in a bear market rally for each one to be slightly lower or nicely lower than the previous signal, okay? So now things have changed a little bit, but not much, okay? Here's a reading below 18 on the VIX index. Close of 1787 on February 1st, okay? Here's the downtrend line, sharpest downtrend line. Here's your sell signal, okay? February 1st is right here, and the downtrend line was broken here. So you got a virtually perfect sell signal right here, okay? And I did a YouTube update around then and talked about it. What's happened since then? Well, we had a nice decline from there, from that potential sell signal in a bear market. But we also followed it with a good rally. Now, for me, the most important thing is when you get these sell signals on the VIX index after readings below that arbitrary number, whether it's 18, 19, or 20, your upside potential is very limited. I think the greatest rally I've seen after a bear market sell signal from the VIX index has been 4%, maybe 4.5%. I'll go quickly through that with you for the last 23 years, okay? But right now, I want to concentrate on what's happened here, okay? The last update we did was right here, April 13th. And on April 13th, we had gotten below 18 again on the VIX index, and we got this sell signal right here. We went above 18, went below it again, and got this sell signal right here. Went above 18 and now have come below it once again. So we've gotten this group of sell signals. The most important thing is, and I wrote down, perhaps we were better served to say the upside potential in a bear market after this occurs, a reading under 18 and a breaking of the VIX downtrend line, the upside potential is minimal before the resumption of the bear market. Rather than being dramatic and saying, oh, we're going to decline big time now. Well, if the pattern follows, we are going to decline big time after one of these signals. But the most important thing about these signals is there is no upside potential in the bear market if you are still in a bear market. Let me show you what I mean. Look at this area up here. This is when we did our last update, right around here, okay? So now what I did, I'm going to zoom in on this. These are daily closes for the S&P cash. And a bunch of sell signals were given here. One was given around here. It's a breaking of a trend line right here, another one. But watch this. This is the close on April 13th, 41.46.22. If you're thinking that was a horrible sell signal or a group of horrible sell signals in here, watch this. From this close of 41.46.22 on April 13th to this close yesterday as we speak on May 30th, Tuesday, May 30th, the first trading day of this week, the rally was 1.4% from here to here, okay? That's what I mean by very limited upside potential once you get below 18 and break a downtrend line on the VIX, okay? So, and even going back, one of my subscribers said, well, Peter, you've been getting these sell signals for a long time now, going back to January, February. And indeed we have. Well, guess what? Here's where we first started getting them here in February, okay? Notice how we got below 18. We've gone nowhere since then. In fact, we just showed you the whole setup for the futures trade because the futures could not exceed this February 2nd high. Very slightly exceeded on the cash. Very slightly exceeded. Let me put a horizontal line right here, okay? That's the February 2nd high. Look at the right of the chart. That's what it was exceeded by. And today, the close today, the February 2nd close was 41.79.76. The close today, 41.79.83. Almost exactly the same as that close. So the upside potential has been nil, nothing. As I said, perhaps we would have been better served by saying that tells us the upside potential is minimal. Now, it also tells us, based on history, that we should be at the end or near the end, price-wise, of a bear market rally, and then a very big decline, okay? a bear market decline. Let me show that to you. Okay, here is the '07 to the '09 bear market. We didn't have very many forays below 18 there. Okay, we had one right near the beginning of the bear market right here, with a close of, in fact, we might not even have gotten under the 18 figure there. It was very close, okay? And again, very close here. But notice where we were in the price structure. Very close here. Here's where the price was, right here. Very close here. Here's where the price was, right here. Then didn't approach it for a long time. Whoops. Going into May of '08. Finally got below it right in here. Notice the price structure, okay? Now it stayed there for quite a while, but the ultimate resolution was big time to the downside. And then finally, I think we just missed getting down there here, close of 1881, and that was just before the final acceleration to the downside, okay? So notice that there was a pretty long time period in here where we were below or close to being below that 18 level. And you could have said there were a bunch of sell signals there, getting below it, getting above it right in here. And that's somewhat similar to what we've seen in the last 4 to 6 weeks. Let's go back to 2000. Okay, same thing here. Very rare. Here's the beginning of the bear market. Here's the end of the bear market. Look at this. Below 18, right in here. From here to here, there was a period of August 9th to, right near the beginning of September. So almost a month right here, playing around with that 18 level. And then, and look where the price was. That's the most important thing. Here was the price right here. The very beginning of the bear market. In fact, for the New York Composite Index, it reached its all-time high right here. S&P reached it back here, New York Composite Index right here. And then the bear market continued, went on and on and on, and finally we got back to that 18 level once again, right around March 18th of '02. Let's call it the middle of March of '02, and we stayed down around those levels. There was a little rally here. We stayed down around those levels until May, the middle of May of '02. So from the end of March to the middle of May, 6 weeks, just like now, we played around with that level. And then finally, boom, VIX broke above this downtrend line into that territory, and look what happened from here on. Wow. Wow. That's where I think we are now. Again, let me emphasize, I'm telling you more importantly that it's telling us the upside is very limited on the S&P. That's where I did the research. And the NDX is another story. We're going to get to that too. That's what the VIX index is telling us. I've had people write to me and even subscribers tell me, but Peter, a lot of people are saying, a lot of analysts are saying that these VIX index readings are very bullish. And I said, really? Well, have them come and debate me. Show me how these are bullish readings, okay, that we've seen in a bear market. Ridiculous. Nothing bullish about them, okay? So that's the VIX index. I've spent a lot of time on it, but it's worth spending time on because it's very important. Okay, next. I know what I wanted to show you, another indication of the limitations in terms of upside potential. I want to zoom in on, first of all, notice that this is a rising wedge formation. That is a bearish formation. But second of all, look at this line. It's not a perfect trend line, but boy, if you count the number of closes on it, when I say on it, virtually on it, like this one, I'd say that's on it, and this one a little bit above, that's on it. Let's count them. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. 11 closes on this line. And I told you what the movement was from here to here. I think it was what, 1.2%. So you can see there has been virtually no potential to the upside on the S&P. And that's the way it should be with these VIX index readings. And I would maintain to you it's going to continue. I continue to think we are very, very close to a big break down in the S&P. But if it's not a breakdown, if we are still in a bear market, there's going to be no big break out to the upside, okay? Look how these closes have been limited. So that's important. Okay, here's the pièce de résistance for this update. Watch this. I was thinking last week and I said, well, how can we show how incredibly overvalued the NDX is? The market overall, but especially the NDX, because a lot of the unweighted averages are doing horribly. Maybe 10 or 20 stocks have been responsible for the whole S&P gain for the year. But watch this. This is a ratio, a spread ratio of the NDX, which is shown up here, divided by the Dow, which is shown right here. So it's NDX, Dow, ratio of Dow to NDX. Okay? This is where we are. Okay? This is a weekly chart. I did it on a weekly chart so we could get a long-term perspective. When's the last time, going back historically? I mean, obviously we saw that at the all-time highs in the NDX, but when's the last time before that we saw this kind of ratio? Which was saying, hey, the tech stocks, the NDX 100, they are so far outperforming the high capitalization stocks in the Dow that it's beyond an extreme that is reasonable. Well, this high in the NDX was touted at the time, in retrospect especially after this decline, but it was touted at the time as being the most overvalued index in market history in terms of what happened, the blow off to the upside, the PE ratios, the book values, the price versus book, any valuation parameter you want to look at. This was crazy right here. NDX divided by Dow got to a ratio that was virtually unprecedented. And here it is right here. Here's the line. Now, compare that with where we are right now, right here and now. Okay? Let's show you a close-up of these few weeks right in here. Here it is. How many weeks were we at a higher valuation? In 2000, the craziest valuations in history, the NDX declined, 80, 90% from there. Look at this. Here's the NDX. March 10th of 2000 was the highest valuation. I think in history before that, we don't have NDX data going way back. But look at this valuation compared to the Dow, okay? And how long did it last in terms of comparison with this week or this past week with the Dow? Well, here's the week before, here's the week after. So 1 week in 2000, the greatest overvaluation in history, 1 week saw a greater valuation than we are in now on the NDX right here. Okay? So that should put things in perspective. Okay? Now, what else do I have to show you? Well, let's compare these two time periods. Okay? What happened with the NDX? Here it is right here in 2000. What happened the first decline and the big rally off that first decline, okay? It's very interesting because remember, the valuation level there is the same as the valuation level here, okay? So let's take a look at the comparisons in market behavior. Here's a little table I constructed, okay? 2000, the initial decline off the March 27, 2000 all-time high on the NDX was 35.7% on a closing basis. There were two retracement rallies following that decline, both of them back to around the 0.618 Fibonacci retracement level. The first bear market rally that occurred was a closing price rally of 34.3%. That was an exact 0.618, 0.6176 before rounding it off, retracement from the May 23rd closing low. Okay, I'm not going to go down further. There was a second rally, 35.6% from the same low. So it was a tiny bit above where this rally ended. Here's the most important thing. From this rally, after the initial decline into these two bottoms that were followed by these two rallies, from 9/1/2000 bear market rally high, the NDX proceeded to decline 80.3% into October 7th, 2002. Okay. Now, that's impossible. That couldn't happen here, could it? Same valuation levels, folks, on the NDX relative to the Dow as we saw here in 2000. Virtually the same valuation ratio. Okay. Now, let's get to the interesting part of the analog. The initial decline off the November 19th of 21 all-time high on the NDX was 35.6%. Compare that with this initial decline in 2000. I don't even have to read it for you. I mean, incredibly close. So far, now initially I wrote this on the weekend. So through May 26th was Friday of last week. There had been a retracement level of 33.9. But with Tuesday's close through May 30th of 23, there has been a retracement level of 34.4%. Compare that with this, okay? Just the fun analog. It may not mean a damn thing. The reason it's interesting is because at these two extremes in the NDX, in terms of its ratio to the Dow, we now have seen an virtually exact, almost pinpoint decline and a virtually exact, almost pinpoint rally from that decline. 35.7, 35.6, 34.3, 34.4. Okay. Thought you might find that interesting. Now, again, to be fair, if we do exactly what we did back then, we have a nice decline and then rally one more time back to virtually the same levels, 34% up, 35.6% up, okay? So somehow I don't see that happening, but if we copy and replicate this exactly, then that's what you see. But in any event, in either of these cases, it's telling you that the NDX is now at an extreme. And here's what followed that extreme right here. How about market sentiment? You heard everybody talking about, there's no way this market's going down. Certainly not down big because everyone's bearish. I mean, all the hedge funds are bearish. All the professionals are bearish. Everyone's saying we're going to have a big crash. Well, let's look at that. This report came out today by Investors Intelligence. I did an exact copy and paste, okay? Hopefully they won't get angry at me for copying this, but I've been around and associated with them for a lot of decades. Not a lot of years, but a lot of decades, okay? Let's go over this. This is critically important, especially with people telling you, oh, everybody's bearish out there. The optimism for a debt deal has helped move the percentage of bulls. Now, let me explain to you the percentage of bulls and bears. The survey they take is not like the AAII, American Association of Individual Investors. This is a survey of professionals. I think they're all newsletter writers, but if not, they're all professional people in the market that have been observing markets for a long time. Okay, so that's what these percentages are talking about. Optimism for a debt deal helped move the bulls up slightly to 47.9 from 46.5 a week ago. That 47.9 reading is their highest reading since they pulled back from their mid-April peak of 50.7%. Remember now, I told you my last update was in mid-April, and you saw where the S&P was at the time, and big deal, it's up 1% from there. But read this. They pulled back from their mid-April peak of 50.7, the most bulls since November of 2021. Guess what happened in November of 2021? That was the all-time high for the NASDAQ 100, the NASDAQ composite, and the daily advanced decline line of the New York Stock Exchange. That's what we're comparing this with. The April peak was the most percentage of bulls since November of 21. Okay, you can pause your video and read the rest of this. I want to go into this. Talks about the bears. Last week's finishing market surge, so again, remember, this was published today, cut the bears to 23.3% from 23.9% last issue. Read this carefully. That is the fewest percentage bears since early January 2022, when their reading was slowly increasing from the super low readings below 20% shown during the 2021 market surge. I'm not going to read it again, but you should. You should read it 2 or 3 times. The latest reading of percentage of bears is the fewest bears since early January of 2022. Well, not all of you out there have a chart of the S&P in your head like I often do, at least on a general basis, okay? So I know what happened in January of 22, but in case you've forgotten, let me show you. We might just as well do this with a futures chart because that's the one I have up, and I want to show you one more thing with the futures chart. But this is the futures for the S&P, okay? Remember the fewest number of bears since early January of 22? When was that? Well, see this point right here? This is January 3rd of 22. That was the closing all-time high in the S&P. Okay, I don't know. I'm not going to go in and look at the futures. They were pretty close to the same thing. But this is early January of 2022, the last time we had as few bears as we have now. Right here, early January 2022. Moving averages are interesting. The general rule with moving averages is if they're longer term, 200-day, 30-week, whatever, when they're rising, a move below them, and that's what happened here in 2020, a move way below them. But at least theoretically, as long as the moving average still moves up, that's a buy signal. You move below a rising, longer-term moving average. It actually started to go sideways here and a little bit down, but it quickly turned up again, okay? So I'm not going to go back to the whole chart to show you how that rule works, but it works very well, thank you. So this is a 400-day moving average. The reason I used it is because I wanted to go back around 400 days to this period right in here. This is the takeaway values, okay? In middle October to late October of 2021. So this 400-day moving average is declining, and it will continue to decline for at least another month. I don't care what kind of great advance you have from here. If I said October, it wasn't October. This is where the 400 days back is, right in here, right when this December rally began. You had this huge rally up, a pullback, another huge rally up. So for 2 months forward from 400 days ago, you had this rally. There's no way you're going to turn this line up. Look where the prices are now and look where the prices were then. Think we're going to get up here in a couple of weeks? Okay. Anything can happen in the market, right? In the meantime, look at the 400-day and look where prices came up to. This is a 400-day on ATES, which is a daily chart of the S&P futures continuation chart, including overnight trading. Let me zoom in on this for you. Here's the 400-day. Came right up to it, had this one day right here on the 29th, 2 days ago, Tuesday of this week, after the holiday, that got a little bit above it and immediately below it again, okay? And basically, that's all I'm going to show you. I mean, I hope it's enough to convince you where the most likely direction is for this market to move, okay? And by the way, if you have a market expert, like one of my subscribers said, that's saying that the VIX index readings down here at 17 and around there, whatever, are very bullish, send them to me. We'll do a debate online for YouTube, okay? Anyway, it's been great giving you this information. I hope you enjoy it. I hope you appreciate it. And let's see what happens, folks. As an old friend of mine way back on the FNN channel, the nation's first financial network, Coast to Coast, used to say, Ed Hart, who was a market commentator, when people said, well, I know that happened this way before, Ed, but do you think it will happen that way again? And he could easily be talking about these VIX patterns. And Ed Hart would always say, we will know in the fullness of time. With that, I leave you. Hope to see you soon. Thank you for watching.